Welcome back to our Foundation to Accounting course. In the previous lesson, we learned what accounting is and why it matters. In this lesson, we are going to learn one of the most important foundations in accounting, the accounting equation. In the previous lesson, we learned that accounting is a system used to record, organize, analyze, and communicate financial information. We also learned that accounting is often called the language of business because it tells the financial story of a business. The accounting equation gives that language a clear structure. If you understand the equation, debit and credit, double entry, journal entries, trial balances, and financial statements will become easier to understand. By the end of this lesson, you should understand what the accounting equation means, the meaning of assets, liabilities, and equity, why the equation must always balance, how business transactions affect the accounting equation, and why this concept is important for students and business owners. For students, the accounting equation is one of the most important foundations in accounting. Before you can understand debit and credit, double entry, journal entries, trial balances, and financial statements, you must understand assets, liabilities, and equity. The equation gives you the structure and shows that accounting follows a logical pattern. For business owners, the accounting equation helps you understand the financial position of the business. A business is more than the cash in the bank. The business may own inventory and equipment, have customers who owe money, owe suppliers, have loans, and include owner investment. The equation helps you see the full picture and assess the strength of the business. The accounting equation is assets equals liabilities plus equity. The equation shows the relationship between what the business owns, what it owes, and the owner's interest. Everything a business owns must come from somewhere. It may come from borrowed money, which creates liabilities, or from the owner's investment, which creates equity. Every business resource must have a source. Everything a business owns must come from somewhere. Business resources may be financed by borrowed money, by credit from suppliers, or by the owner. This is why assets appear on one side of the equation, while liabilities and equity appear on the other side. Assets. An asset is anything valuable that a business owns or controls and can use to generate future benefits. Assets show the resources available to the business. If a business has money in the bank, that money is an asset. A laptop used for work is an asset. Goods available for sale are assets. If customers bought goods on credit and have not yet paid, the amount owed is also an asset because the business expects to receive money in the future. Assets also include equipment, vehicles, buildings, and land. An asset does not need to be cash. It can be any valuable resource that supports the business. Types of assets. Assets are grouped into current assets and non-current assets. Current assets are expected to be used, sold, or converted into cash within a short period, usually 1 year. Examples of current assets are cash and bank, inventory, accounts receivable, and prepaid expenses. Non-current assets are used over a longer period and are not normally bought for immediate resale. Examples are land and buildings, motor vehicles, furniture and equipment, machinery and equipment. Liabilities. A liability is an amount that a business owes to another person or organization. Liabilities show the financial obligations of the business. Liabilities answer one key question: how much does the business owe? Liabilities are not automatically bad. Loans and credit can support growth, but they must be managed carefully. Examples of liabilities are bank loans, supplier balances, rent payable, salaries payable, taxes payable, utilities payable, short-term credit, and finance leases. Liabilities arise when the business receives value now and must pay later. Types of liabilities. Liabilities are grouped into two: current liabilities and non-current liabilities. Current liabilities are amounts expected to be paid within 1 year. Examples are accounts payable, short-term loans, unpaid wages, taxes, utilities, and rent payable. Non-current liabilities are amounts that will be paid over a longer period, usually more than a year. These include long-term bank loans, mortgage loans, long-term finance leases, and other long-term obligations. Equity represents the owner's interest in the business. It is what belongs to the owner after liabilities are deducted from assets. Equity may come from the owner's capital, additional investments, and profits retained in the business. If a business has assets of 50,000 Ghana cedis and liabilities of 20,000 Ghana cedis, the equity is 30,000 Ghana cedis. After paying what the business owes, the remaining value belongs to the owner. Why must the accounting equation always balance? The accounting equation must balance because every business resource must have a source. If the business owns something, it must have been financed in some way. An asset may be financed by the owner, by a lender, or by a supplier who gave goods on credit. This basic relationship is the structure behind accounting. Imagine that a business has assets worth 100,000 Ghana cedis. Perhaps the owner invested 60,000 Ghana cedis and the business borrowed 40,000 Ghana cedis. The assets are financed by liabilities of 40,000 and equity of 60,000. The equation remains balanced. Let us use Majesty Nuts Cashew as a simple business story. The owner starts the business by investing 5,000 Ghana cedis. The business then buys raw cashews for cash and later buys packaging materials on credit. These transactions will show how the accounting equation changes while remaining balanced. Transaction 1. Owner invests 5,000 Ghana cedis. The owner invests 5,000 Ghana cedis into Majesty Nuts Cashew. Cash is an asset, so assets increase by 5,000. The owner's investment creates equity of 5,000. There is no liability yet. The equation becomes 5,000 assets equals 0 liabilities plus 5,000 equity. Transaction 2. Majesty Nuts Cashew uses 2,000 Ghana cedis of cash to buy raw materials. Cash decreases by 2,000, but inventory increases by 2,000. One asset decreases and another asset increases. Total assets remain 5,000 and the equation still balances. Before the transaction, cash 5,000, inventory 0. After this transaction, cash 3,000, inventory 2,000, total assets 5,000 Ghana cedis. Transaction 3. Majesty Nuts Cashew buys packaging materials worth 1,000 Ghana cedis on credit. Packaging materials increase assets by 1,000, while the amount owed to the supplier increases liabilities by 1,000. Total assets are now 6,000 Ghana cedis, liabilities are 1,000 Ghana cedis, and equity remains 5,000 Ghana cedis. The equation still balances. How transactions affect the accounting equation. Every business transaction affects at least 2 parts of the accounting equation. Sometimes one asset increases while another decreases. Sometimes assets and liabilities both increase or both decrease. Sometimes assets and equity both increase or both decrease. The equation must remain balanced after every transaction. Transaction examples: investment and borrowing. When the owner invests cash, assets and equity increase by the same amount. When the business borrows money from the bank, cash increases and the loan liability increases. In both cases, the accounting equation remains balanced. Buying assets. When equipment is bought for cash, equipment increases and cash decreases. One asset replaces another, so total assets remain the same. When goods are bought on credit, inventory increases and accounts payable increases. Assets and liabilities increase by the same amount. Transaction examples: payments, revenue, and expenses. When the business pays a supplier, cash decreases and accounts payable decreases. When the business earns cash revenue, cash increases and profit increases equity. When the business pays rent, cash decreases and the expense reduces profit, which reduces equity. Where do revenue and expenses fit? Revenue and expenses affect equity. Revenue increases profit, and profit increases equity. Expenses reduce profit, and reduced profit decreases equity. Some people use the expanded equation, but beginners should first remember the basic structure: assets equals liabilities plus equity. Two businesses may each have assets of 100,000 Ghana cedis each. One may have liabilities of 80,000 and equity of 20,000. The other may have liabilities of 20,000 and equity of 80,000. Their total assets are the same, but their financial positions are different. Common beginner mistakes. Common mistakes include thinking assets mean profit, assuming liabilities are always bad, forgetting that equity represents the owner's claim and ignoring the need for the equation to balance. If assets do not equal liabilities plus equity, there is an error in recording, classification, or calculation. Quick practice. Question 1. Find the equity. A business has assets of 30,000 Ghana cedis and liabilities of 12,000 Ghana cedis. Equity equals assets minus liabilities. 30,000 minus 12,000 equals 18,000. The owner's equity is 18,000 Ghana cedis. Example 2. Find the assets. A business has liabilities of 25,000 Ghana cedis and equity of 40,000 Ghana cedis. Assets equal liabilities plus equity. 25,000 plus 40,000 equals 65,000. Total assets are 65,000 Ghana cedis. Example 3. Find the liabilities. A business has assets of 80,000 Ghana cedis and equity of 50,000 Ghana cedis. Liabilities equal assets minus equity. 80,000 minus 50,000 equals 30,000. The liabilities are 30,000 Ghana cedis. Key takeaways from this lesson. The accounting equation is assets equals liabilities plus equity. Assets are what the business owns. Liabilities are what the business owes. Equity is the owner's interest. Every resource must have a source. Every transaction affects at least two elements, and the equation must remain balanced. Revenue increases equity, while expenses reduce equity. Now that you understand the accounting equation, you are ready for the next major foundation, the double entry principle. The accounting equation gave us the structure. Double entry will show us the mechanics and explain why every transaction affects at least two accounts. See you in the next lesson.